officially welcome all of our panelists as well as all our attendees. We've got almost a count of 200 so far, and many others will join in as well when they wind up with their Tuesday work. And, I was just thinking about while miking up for this webinar, what a time this has been. From the last time that we spoke with all these panelists on exactly the same topic, that's 10 stocks for the next 10 years, the market was just so different. And since then, what a staggering recovery it has been. Not the close today, but at the start, at least, we managed to have a touch and go moment with that 10,800 mark. Having said that, while lots of the market has already recovered, there are still a lot of question marks ahead as to what is it that you put your fresh money in. People who actually bought, who were brave enough to buy the March lows, they're of course sitting happy, but there are many with that left out feeling, or FOMO as we call it in the social media slang, who are wondering what to do next and what is it that you should be buying or perhaps even selling at this juncture. So what we thought, considering just about every management that we're speaking with on ET now, barring a few, have no idea what's going to happen in the next 1 or 2 quarters or even going forward. There's absolutely no visibility in these COVID times. So we thought, forget the next 1 or 2 quarters, forget today and tomorrow. Let's look ahead. Let's look at next 5 years, next 10 years. What are the compounders, the multi-baggers that you can buy in the uncertain times right now? And then just sit pretty, and after 10 years, be happy and make money on those. So joining me today are very special panelists. I've got Sandip Sabharwal joining in all the way from Chandigarh. We've got Vikas Khemani from Mumbai, Manish Sonthalia, as well as Pankaj Murarka who's joining in. Gentlemen, evening. Good to have you guys on the show. And at the onset, let me just say that this is not ET Now as a channel making recommendations, or for that matter, any of our panelists as well. Please do your own homework, do your own research, and do consult your financial advisors before going out and buying any of the stocks that our speakers do talk about. And yes, suffice to say that they or their firms or their families may have a vested interest in the stocks that they talk about. Okay, on that note, Manish, let me start off with you. Last when we spoke was what, 2.5 months back? What has happened since then? I'm just rubbing my eyes in disbelief. What is this market pricing in that most of us are unable to see?
The numbers are going to be bad for FY21, and there's a whole lot of liquidity sloshing around in the global system. $17 trillion to be precise. Central banks have pumped much more than what the seriousness of this pandemic would have warranted. And this is all at 0% interest rate. So, it really doesn't make too much of sense to, park these money at 0%. You wouldn't fulfill any of your needs. So there's a TINA factor as far as global equities are concerned. If you can't justify numbers for FY21, better to move to FY22. And FY22 numbers are going to look pretty strong on a very low base of FY22. So that's what is happening in the markets post March and April.
Vikas, from the kind of questions that we're getting today, from the number of registrations as well, one gets the feeling that retail players are still, sitting with that missed out feeling. Damn, why didn't we buy those March lows, or for that matter, even jump in April? Do you think the FOMO factor is also at play over here? When you've got promoters which are selling out for whatever reasons that they may have, but retail participants, or for that matter, even DIIs, are still seeing long-term value in those stocks?
So I think market always guided between the fear and the greed. I think at 7,000, when market Nifty was there, everybody was kind of thinking around 6,000 and more fearful. And as the markets have recovered, there is a first sign is fear of missing out, and then people jump in, and that's where the sort of greed comes in. So I think it's always between two. And again, I feel that you have to look at markets from a longer term perspective. Fundamental always plays out. Short term, there could be liquidity issue always in markets, both sides, both upside and downside. So one has to look at investing from really long term point of view and create wealth from long term point of view. In shorter term, markets can always surprise you both on downside as well as upside. And of course, there was a very once in a century kind of event, which fortunately is kind of getting behind us. Both health in terms of health crisis and as well as the economic crisis. So I think markets are kind of looking forward, and as the comfort is settling in, as the fear is residing, more and more people wants to come in and park their money. And as Manish alluded that, there is no sort of option right now. The fixed income option has kind of become so less attractive. FD rates pre-tax are like between 4-5%. So, whereas the dividend yield is around 2-4%. So I think, it makes a lot of sense to go towards equity, especially in the beaten down market. And that's where I think markets are sort of ignoring the shorter term and looking forward from 21, 22.
So I think you in that sense have been a little circumspect about this rally, right? Because macros are clearly pointing towards one thing and market prices are doing something else. Do you still believe that there could be a better time to jump in, or do you say that, you know what, forget looking at the index levels, forget that we've seen that staggering recovery from the March lows, keep your stock list ready, monitor those stocks and buy when, it looks comfortable to buy?
Yeah, so the economic realities on the ground are not so great, and I actually am of not the opinion that both the health crisis, like Vikas was saying, health crisis or the economic crisis is behind us, because the health crisis is very much there. If you look at the number of COVID cases, not only in India but worldwide, they're actually pretty high, and the peak doesn't seem to have reached. There is no vaccine as such. So I think so we can debate this a lot. But the whole point is that the reality of the economy is not as great, and we are finally an economy where all of us know there's been hardly any fiscal stimulus. In fact, there's been a taking away of money from people in the form of fuel taxes. So the reality on the ground is very different. When you come locally, like I'm in Chandigarh, if you read local papers, you read about what local businesses are facing. In fact, I was so surprised that to read today morning that 1 lakh people have been fired from schools in Haryana, private schools, the peons, the support staff, etc. So I think we can't run away from that reality. There are some companies who are coming out and making statements that they are back to normalcy. I find it very tough. So if with such a huge COVID event we can come back to normalcy so soon, then why was anyone asking for a stimulus at all? I think it's going to be a phased wise recovery. It's a long drawn affair. I think there is euphoria, then there will be reality setting in, and that will give the opportunity. So as I look at the markets today, so obviously you get opportunities to make decent amount of money via picking out the right stocks. So that's the strategy I'm following, which is not what this program is about. So this program is about long-term investing. So I think for long-term investing, we have to go deep value now, not look at what's going to happen in the next 6 months, but look at what's going to happen over 2-3 years. And if I can invest in those deep value stocks, I'm sure a lot of money will be made still.
Right. And Pankaj, would you say that amidst this uncertainty, that's the right approach? Cut through the noise. Don't look at 1-2 quarters as well, because not even any retail participant, FII, or for that matter, any global leader or the companies themselves have any clarity on when we're going to get out of this mess, whether there's going to be a vaccine or not, whether to look at science, whether to look at macros or micros for any sort of cue. Look ahead, go into the next 5 to 10 years, drop your list and start buying.
Absolutely, I think, Aisha. Obviously, there are a lot of concerns around health, economy. Most people are intrigued by the behavior of the market because in the middle of the biggest health and economic crisis, we have sown the seeds of the bull market. Meaning the fact is markets up 40% from the lows, right? Yeah. That's the kind of return you make in a firing bull market. To expect that kind of returns at an index level, and a lot of stocks have done much higher than that. In middle of a crisis, I don't think so anyone anticipated or expected. So I think there are too many moving parts to this. My view is twofold. One, I think just to cut all the noise, let's be very clear. My view is we are firmly in a bull market. Yeah, whether we like it or not, whether we can reconcile to it or not, we can keep debating and conjecturing. The fact is global equities are in a bull market. Now we can discuss and debate what's driving this bull market. Okay. So that's the first point. Second thing is I think investors should not think too much about global economy, Fed, central banks, and so on and so forth. They should just have their list of 10 businesses which they think are rock solid, and which probably because of this crisis, they've been probably there could be an opportunity for them to buy at prices which could be lower than what they would have otherwise bought, and buy those businesses with a 5 or 10 year view and just let things work out. If there's a problem with the economy, if there's a problem with liquidity, I think there are enough regulators and policymakers doing the job and they'll sort it out. As long as the 5 or 10 or whatever companies have invested in, if they're doing fine, you'll be fine, and markets will figure out their own way. Obviously, there's euphoria as it is. And in fact, the kind of euphoria itself tells you that we are in a bull market, because you don't have euphorias in bear markets. So there will be pullbacks, there will be corrections, and there will be noise. I think the key thing for investors, if you're taking a medium-term to long-term view, and which is what is needed for wealth creation, is just cut all the noise, focus on companies, get 5 or 10 companies, invest into them, and just let things play out.
Fine. Okay. On that note, since we're here to talk about stocks, we're here to talk about the multi-baggers that you could buy right now. Let me begin with the first stock. And Manish Sonthalia, AU Small Finance Bank. Why AU? And firstly, I want you to tell our viewers a little bit about what this bank actually does, what kind of exposure, what kind of lending does it have, a little bit about what exactly do they do.
So this is one of the new licenses that was given to AU Small Finance Bank. It was a NBFC prior to this, and they have had some very good track record in terms of how they have lent out to, automobile financing has been the major portion. That is their strength. Even today, 40% of their loan book comes from the auto financing business, and they are very prudent to not have, let's say, more than 5% of that 40% exposed to the CV space. And that CV space actually lends a lot of cyclicality to the whole auto financing business. So they are very prudent in keeping away from that space. And because the RBI actually thought that these guys had done some credible work, they were given this license some time back. This is quite an old bank. And, the way they have executed gives us enough confidence that AU Small Finance Bank, after 10 years, it's a 10-year compounding story according to me, because if you look at the last many years track record, they have grown at roughly 50% in terms of their profit growth, and with a NPA of something like 1.5% and ROE profile of something like 14%. Now, coming to the reasons why I like this bank, first of all, Mr. Sanjay Agarwal, who is the MD and CEO of the bank, has a skin in the game. He still owns 30.95%, and we have found that entrepreneurs who actually have a skin in the game, they would manage the show much better than those who don't really have a skin in the game. It's a universal truth. And Mr. Sanjay Agarwal, he's the MD and CEO, Mr. Tibrewal, who is also a full-time director in the company. They have a very strong lineup in the second-tier management. So quality of management, whether it be Rishi, Dhariwal, that lends a lot of comfort in the capability of the management. The second is that they actually hand out loans based on the philosophy that these assets which they fund are based on income bearing, and it's not against just the value of the collateral. And this income bearing capabilities are gauged based on, let's say, daily cash flows or monthly cash flows. So, and these are fully secured loans. So if the cycle also goes bad, it doesn't really mean that much of these loans are actually going to convert into NPAs, and that is what they have demonstrated. Third point is that they have a very strong collection agent field force, and that gives a lot of comfort in the fact that these guys are actually handing out low ticket loans, and basically also to the self-employed segment where the income profiles are not very continuous, or it's not very streamlined. You could have ups and downs in businesses, but because they have very strong field collection force, collection agents, and in banking and lending and borrowing business, it's all about collections. So, that gives us comfort. At the same time, they have very strong knowledge about the community and the areas where they are lending to. That is really, giving them a very strong competitive advantage, as opposed to private sector banks where they have a template-based lending. So this is basically not the forte of the private sector banks when they can replicate this knowledge about the community in which they are operating. And third is, and the last point is basically that they are trying to maintain their lending book in areas which they understand. So as they have been having a very good track record as far as automobile financing is concerned, within that they are trying to find a niche for themselves, whether it be, let's say, funding of fast cars or whether it be the funding of SUVs, etc. That doesn't lead a lot of cyclicality to those businesses along with the small businesses which they are funding. So I think because of the execution track record and there's a huge runaway to growth, valuations are going to likely remain slightly on the higher side when compared to the banking sector. Of course, the stock has corrected, but it's a very steady compounder of 20-25% over the next decade. That's what I believe.
Yeah, Manish, that's a very valid point that you said, because when you look at the India context, I don't think it's about lending. Anyone will give you money. It's about whether you have the might and the wit to really recover money or not. And if they win there, I think it's a hands down winner. But the other thing, Manish, I mean, I'm just wondering, financials as a cluster have recovered quite a fair bit in the last month and a half. And you've got your leaders like Bajaj Finance, for instance, we talked about, or a Bandhan Bank, etc. as well. AU Small Finance Bank has recovered barely 1% from the March lows, and it's barely even halfway from its 52-week high. Does that make it, more lucrative a buy? And I'm also on the same hand wondering, why is it that it's not participated in the financial rally?
See, the 52-week high on the stock was 1,200 rupees, and currently the stock price is 600. So it's roughly 50% down from its all-time high.
Right.
I think the markets are a bit apprehensive about the CEO actually selling a portion of his stake at a lower price of something like around 400 odd rupees. Maybe that's the reason, but that has nothing to do with the working of the bank, according to me. And I think slowly and gradually over a period of time, the guys who are actually sold out, I mean, that's basically finding their place in stronger hands. It's just the confidence on the fundamentals and the intricacies of their going about the lending and collection business gives me a comfort that this stock has a long way to go on that.
Sure. On that note, Sandip, I want to get you in as well, because you have a similar view on another financial name. That's Mahindra and Mahindra Financial. In the context of the current financial market, where stressed financials have taken a beating, I'm guessing it'll all be about survival of the fittest. Do you think MMFSL is fit enough to really lead in this recovery?
Yes, I think what we need to see when we look at financials is that what's the parentage, and the parentage of obviously Mahindra and the financial is Mahindra and Mahindra Group, which is a very well-regarded group in the country. Now, Mahindra Financial had its own issues related to first lower growth in some of the segments in which it operates, then agriculture crisis, because of which the NPA cycle for Mahindra Financial was very different from some of the urban-centric financials like Bajaj Finance, etc., where so they are more an urban story rather than a story which is more towards rural, semi-rural, and to some extent urban. So my bet here is that from the levels at which we are today, the way the markets are rallied, we have to look at deep value in the market. So when we look at deep value, I believe that Mahindra Financial is very well positioned because one, obviously there is a rural revival story coming through, and typically rural revival, if it happens, it will play out for 2-3 years because typically the cycles in the rural areas tend to be somewhat longer term. The second part is that on its market cap today, if you look at it, it's just around, today I'm not sure what it was, so I think it's just around 10,000-11,000 crores. So for such a large NBFC operating for so many years with a balance sheet of more than 70,000 crores, market capitalization of this much is quite low. It trades at just around 0.8, 0.9 times book value, which is very low. At one point of time, it used to trade at 3-4 times price to book also when it didn't have all the balance sheet issues, etc. So my bet is that NBFCs which come from strong groups will survive and eventually thrive. I think near term everyone has pressure, and that all of us know about. And that's the bet people have to take. It's still cheap, like peak was 500-600 rupees. I think today it trades at 200, went down to 140, 150 or even lower during March. So it started a recovery process. It could be volatile if markets do give up gains in the second part of this year and this quarter. We could see this stock also correct. But for someone who takes a 2, 3, 4 year view, I think there is tremendous value, and I think that's what I would bet for. And the stock could double, triple over this time period.
Because, on the subject of financials, you always wonder, since we're here digging out compounders, why not stick with the leader? Why not just buy an HDFC Bank, ICICI Bank and Bajaj Finance, evenly distribute amongst the 3 stocks and not look at mid caps right now?
Sorry, Aisha, did you ask me the question?
Yes, Vikas, you.
Sorry. Can you repeat that? I'm so sorry.
No, I'm just wondering, why not stick with the leaders? Why not stick with the top 5 names within financials then? A cluster and a combination of an HDFC Bank, ICICI Bank, Kotak and a Bajaj Finance. The leader in lending when it comes to that.
Absolutely. I mean, there's no question. In any sector, if you ask me, if you want to capture a good return, you should always stick to the leader. And the only thing you have to kind of think about is the valuation part. So as long as the valuation is a fair range, and HDFC Bank has delivered a significant return over a long period of time, and that's the kind of stock you want to sort of remain invested when you are talking about 8-year, 10-year kind of period. So yes, of course, in any sector you should look at sector leadership, number 1 or number 2 place.
Manish, it's been comforting, right? The Q1 commentary that one has heard from a Bajaj Finance, from a Bandhan Bank, as well as HDFC Bank, irrespective of how distinct their nature of the businesses within banking and financial services have been. But what was meant to be a watershed quarter or a washed out quarter, these guys have shown you resilience and they're showing you conviction in the business.
Aisha, I mean, the markets are now fully convinced about the fact that the banking system is going to see a gross NP of something like 5%. This year to 6% as against the normalized GNPA levels of around 2-2.5% for the banking sector.
Sure.
So our total GNPA in the system is going to go something like 12.5-13% for the system as a whole. Fact in that, apart from let's say an HDFC Bank where the moratorium book was just about 8-9% of the total book, entire banking system right from let's say Bajaj Finance from 27% to something like the CD guys having extended moratorium to the extent of 90-95%. And we are still under the moratorium period. The term loans are under moratorium till about 31st of August. And everybody is just trying to figure out in this whole lockdown as to what the loss given default on this assets under moratorium is going to be. I mean, if you take a thumb rule of something like 20% being the loss given default on the moratorium book, I mean, it's going to be quite challenging for the smaller guys, because your pre-provision operating profits are just about, let's say, 2%, 2.5%, and you have, let's say, if a bank has, let's say, 30% of its book under moratorium and the 20% goes loss given default, you'll have a 6% GNPA. If you are having a pre-provision operating profit of 2.5%, your 3 years of profit gets wiped out unless the pre-provision operating profits grow. Now, lending is a function of how the GDP is growing. Your GDP is just about growing at nominal GDP will be 0% this year. I mean, minus 5% real GDP growth and 5% inflation. So nominal GDP will be just about 0%. So, I mean, how strong can you lend? If your nominal GDP is growing, let's say 0, you can grow at best 5 to 10%. So pre-provision operating profit, at least for the visible next 1.5 years, is not that great. So the stronger banks and stronger NBFCs, are going to come out much better, but the growth rates are actually going to come down. And there is where I think the smaller guys have a advantage of a smaller base. I mean, if let's say at 1,40,000 crores of Bajaj Finance, they can't grow at the normalized 35-40% that they have been growing at. The growth rates are actually going to come down, and that's also symptomatic of the fact that the price to book with this entity used to get previously at 7 times, 8 times, 10 times. It's really not doable. So here is the case where smaller, guys who are executing well, like Small Finance Bank AU, 50% over the last 10 years, and 14% ROE, very decent, collateralized lending, and let's say a NPA profile of just about 1.5%. That is
Fair
speaks
point.
much better.
Fair point. Because on Nippon Asset Management, which is one of your stock ideas, and you believe that this is a good long-term bet. Why is that? I mean, does the business have a moat around itself? And more importantly, are there checks and balances with regards to both growth and corporate governance?
So I think, Aisha, when you look at any stock for 8 to 10 years perspective, you need to look at four things, right? Moat, return on equity, cash flow, free cash flow, and the growth and governance, right? These are the, at least four things you have to, or five things you have to focus on. Asset management business per se, if I were to come, I think it's the only business I know where once you acquire a customer, there's the internal compounding. As the markets go up, you don't need to acquire one more customer, your current portfolio also keeps growing. And then on the top of it, you acquire new customers. So you have twin engines of growth coming in the business. And I think that's a very, very good characteristic of it. I don't know many other businesses which have this kind of, most of the businesses you have to acquire a customer again and again and again and again, right? And this is like internal as well as the external compound. And that's what I think makes the business very interesting. Secondly, I think the operating leverage is very, very high in this business. So, and if you look at, Nippon Asset Management is, one of the top 5 mutual funds in the country. They have had, their track record over a long period of time. They are owned by now Nippon, which is a global MNC, 75% owned by them. They have a very wide distribution range. So, if you think, India's story is going to play out, equity wealth creation is going to happen. If India, its GDP is going to go to $5 trillion and the market cap is going to migrate or go up from $2 trillion to $5 trillion. Even if they maintain their market share, they will participate in this sort of growth, and it will have both. It's an annuitized business with a growth bias. So I think and there are not many uncertainties around the business. Of course, you have to keep executing well. There's no question on that in any business. So you have to also perform. But I think in a retail-oriented business, I mean, I would not believe that's a very sort of very difficult and big deal. So I believe, given the track record of the team, so I believe that this story can keep compounding with the least volatility or with the lower volatility for a long period of time. Of course, when markets go down, this can also kind of bring some amount of volatility, but that is not a structural weakness in the business. The business keeps kind of doing well over a long period of time. So here, I mean, I like the inherent nature of the business as well as the current the ownership profile, the governance profile of the company. And I truly feel that over the next 8-10 years, it can give 15 to 18% compounding, which is very hard to get in many businesses.
So that's a good one. Pankaj Murarka, Syngene. Now I understand that pharma is really the flavor, so to speak, of late. It's the next big thing that everyone's discovering about India. It is a leading CRAMS company in India, but it's already close to its 52-week high of 447. Do the prices right now and the valuation really give you comfort? And if you are indeed recommending the pharmaceutical sector, why Syngene and why not any other company?
Well, to start with, first thing, great businesses are always expensive.
Good rescue, Pankaj.
Just go back in history and see Amazon when it was in post the technology meltdown in 2001. It almost went broke, yet it was trading at 100p. Yeah, you could have argued that Amazon was expensive at 100p in 2001 and you missed a 200 bagger. So I don't think so. Valuation is the prism through which we should evaluate businesses. They will go through their own cycles of corrections. What is more important is how do you think about the business over the next 5 or 10 years? Because we are really thinking, talking here really long term. 10 years is a reasonably long period of time, and it is half a generation, if not a one full generation. So I think there are 2 or 3 megatrends playing out here. There is a big I think this whole CRAMS sector globally is at a very big inflection point. Globally, large pharma companies are facing significant challenges on their cost front. And they're looking for solutions where they can do their research at a price which is 20, 30, 40% cheaper than what they're otherwise doing. Yeah, because there are significant challenges which they're facing on their business. And I think India, with its kind of skill sets that we have in chemistry, technology, and people, is at a very unique point in terms to take a significant share of this opportunity. To my mind, meaning just to share with you, I started my career as an IT analyst way back in 97. This whole CRAMS industry in India is exactly where the IT industry in India was in early 90s. Infosys then was a small cap, not even a mid cap. Yeah, and one could have argued that Infosys, when it got listed, didn't have a good listing, but a lot of these companies at some point of time were 80-100 P, yet they've delivered phenomenal returns to investors over the last 15-20 years. I think high growth businesses, high quality businesses will trade expensive, and that should not hold back investors from investing into these companies. If you want to buy this is like buying a Rolex watch versus a Titan watch. If you want to buy a Rolex, you have to pay a price for it. So I think it's a very unique business. Probably it's amongst the leading CRAMS company in India when it comes to Syngene. And probably my view is that probably it will become while it's a mid cap today, but given the kind of skill sets they have and the opportunities that lies ahead of them, I think it will become a very large company in India over the next 10 years.
That's a great view coming in there. Vikas, I have two viewer questions for you. Before we move forward to our next round of stock ideas, let's just get that answered, because both Aditya Chavan as well as Satish, we have said that since you did say that stick to the leaders in the pack when you were talking about financials, why Nippon Asset then? Why not stick with an HDFC AMC, which is the leader? Fair question, I would say.
It's a fair question. There's no, denial of that, and as one can choose between both. The reason why I feel HDFC, at this point in time, because I see a lot of selling happening within HDFC, AMC, or by the both promoters and some of the insiders. HDFC also is a sort of market leadership. It's going through their own internal management change, according to me. We had a recent CEO change. HDFC as a franchise has been around for a long period of time. And till the time we sort of see that settling down, of course, HDFC is a great brand. There's no question on that. But I feel, Nippon is the one place where you can get both earnings growth as well as the valuation related. And that's where probably slightly superior return can be made versus HDFC mutual fund, where re-rating will be difficult, but growth will come about. But I like both companies. There's no question on that. Having said that, from a business matrices perspective, Nippon also is a very good business matrix. I think their distribution reach, without having a strong brand like a banking brand of HDFC, they still have a very good distribution network, especially B30 towns, and which is a very, very high growth area. So I feel that's the reason we chose between HDFC and Nippon to Nippon. But having said that, both are good business.
Sandip, this is one question that I want to take up with you, because Manohar Tar has said, what about Manappuram Finance? Now, we all know with regards to what's going on with gold prices and the movement that one has seen in Manappuram Finance and the surge in gold loans, which has done great for the business. But the problem with gold is that the gains may not be here to stay for the next 5 to 10 years. While right now, yes, it's the dearest and the shiniest yellow metal that you've got there. Do you think that could be a challenge when you're looking at Manappuram Finance from a long-term perspective?
Not really, Aisha. In fact, I like Manappuram Finance a lot, and my view on gold is very contrary to what actually you were saying. I believe that gold will enter into a super cycle of gains as the money printing of the Fed and various other central banks ultimately leads to not a growth revival, but a revival in inflation at some stage. Now, when that will happen is a conjecture, because right now unemployment is very high all across. But eventually, I think Fed funded bull markets in assets don't end well. So when they don't end well, so what is your alternative? Your alternative is gold, and I think gold will do extraordinarily well. In fact, the prices which gold could be trading at 5 years from now might not be imaginable for all of us. So I think if gold price is to predict the price of Manappuram Finance, in fact, Manappuram Finance should do much better. But I think since we are on this topic of where people should be investing for the next 5 to 10 years, I think they should have gold in their basket for sure.
I hope you're not recommending a larger exposure to gold as opposed to equity, Sandeep. That will be against our DNA.
At this stage, yes. In the long term,
Okay. safer at that. Since we've just talked about pharmaceuticals, Manish, I don't know if you track these companies, but Ed Ghosh has asked about a view on a Granules and Biocon for the long term. Would you be tracking any of these names?
Yeah, we do track them. I mean, I don't have a specific view on these companies, but what I can say is that guys who are basically into the manufacturing of APIs, and export of APIs are likely to do much better than what they have done basically in the past. And this comes on the back of the China restrictions and the whole focus towards a better opportunity in the pharmaceutical space, because the focus is now on lifestyle and healthcare.
Sir, Aisha is just trying to connect back. Her internet is giving some issue. You can continue, sir. We can all hear you.
Yeah, I mean, that's what my view has been, that guys who are more into the API exports and API manufacturing have a bigger demand now than what it had been in the past, due to the China issues and the greater focus on healthcare and lifestyle going into the future. Prices have also stabilized. It's only the key starting materials, the guys who have a backward integration, are likely to do much better. And Granules is a play in that direction. For biotech, of course, it's to do with glargine, insulin, and that has a lot of promise in the days ahead, and that's actually lending a helping hand to the stock price.
Okay, great. So would you continue with your next stock pick, which is Voltas then, since we are talking about your stock picks here in particular?
Okay, sure. I like Voltas for the simple reason that, India today, India is a warm country. I mean, as opposed to China, it's a much warmer country. And China basically manufactures and sells something like 93 million air conditioners, room air conditioners every year. Out here, we are just about selling 7 million air conditioners, and our penetration rate in this category of consumer durables is just about 6 to 7%. So, given the fact that the size of the opportunity is immense, given the size of our country, and it's a much larger country than what the 7 million indicates, the category growth is here to stay for many, many years. The second reason is the affordability. I mean, if you see, the price of an air conditioner has broadly remained the same in the last 10 years or so, and today you are getting a better quality air conditioners, the inverter AC, so on, where you have a 15% lower power consumption cost, and you have many added features like air purifiers, etc. And basically, this can lead to a J curve going forward, given the size of the opportunity and the fact that the category has seen a 14% CAGR growth over the last 10 years. Only mobile phones as a consumer durable category has seen a higher growth than the air conditioner growth. So there's a J curve possible out here. Now, Voltas comes from the house of a Tatas. They have a top-notch management execution. The customers have a huge trust in the Tata brand name, and they have a very wide distribution reach, highest in the country. They have a 25% market share, and the after-sales service is a very important distinguished point between competition and them. So distribution points, after sales service, trust factor, as well as the execution from the management has allowed it to have a market share of something like 25%. And you know that air conditioners are basically a push product, and the growth has also been expedited. This 14% CAGR growth has also been expedited by consumer durable financing, the likes of Bajaj Finance. You know, the more subvention you give, the more your product sells. And since it's economies of scale business, the more you sell, the more the profits you get. It's a very profitable category in terms of return on capital employed. For record purpose, Voltas has had a profit of something like 550 odd crores for FY20. The free cash flows were 400 crores, and the total capital employed in the business is just about 1800 crores. So the profitability and the return matrices look great, and the size of the opportunity is huge. They have executed to perfection, and till about the doubling of the penetration rate. I think there's a huge leeway to growth out here, and that's the main reason why we like this for the next decade. The JV between Beko and Tatas, it's only an option value because they are going into other categories like washing machines and refrigerators, and other categories of consumer durables where the competition is much lower. The way they have gone about executing in the air conditioning space, if they were to match the same execution skill in the JV, which has just recently got formed, I think the market size opportunity for the company as a whole grows tremendously. And that will have a further growth on the return matrices for this company, because it's a JV, 50-50 JV, not all capital is being provided by Voltas itself. It's a very strong balance sheet and very high dividend paying company. So these are the main reasons why I like Voltas for the next decade.
Okay, great. Sounds great. Mr. Murarka, your next topic is Info Edge, I believe. Would you want to talk about it? Why do you think we should invest in that for the long term?
I think, so one thing is very apparent that in India, we've seen explosive growth in smartphone penetration in the last 2.5 years. And if at all anything, the use of technology in businesses is going to increase both on the consumer side and on the enterprise side is going to increase exponentially over the next 15-20 years. What has happened in the West probably will play out in India over the next 10-15 years. We are just at the cusp of a big technology revolution, if I may say so, in India, and we are just at the beginning of that cycle in terms of what we've seen in the West over the last 15-20 years. And I think InfoEdge is a pretty classic company. Meaning it's a technology company. It businesses cuts across some very unique and very strategic segments or sectors in India, with their three businesses around the flagship business, which is the cash cow currently, is the jobs portal, the Naukri.com, which is the incumbent and the leader in India. And given given the growth potential of India from overall economy point of view, India will always be a country where there will be scarcity of good talent, and job portals or recruitment portals have a significant role to play there. So that business will keep growing. They have other two technology-driven businesses, which are, one is in the real estate space and the other one is in the matchmaking space. I think all three businesses over a period of time should do exceedingly well. And with the greater adoption of technology, if at all, the customer base and penetration levels should increase even further. Apart from that, they also invest into a lot of other, they seed or invest into a lot of other emerging technology businesses. Obviously, as we know, technology is a high-risk business, so some of those investments might not work well, but when it works, some of them really work really well. Their two big investments obviously are Zomato, which is now probably the leading player in food distribution and on the restaurant platform, and InfoEdge owns a very significant stake there. And the other one is Policy Bazaar. And likewise, obviously, they have a portfolio of other companies which are at different stage of evolution in which they've invested, and probably they'll keep investing. So I think probably InfoEdge is one classic company if you want to play the technology, evolution of technology in India. The good thing is I think they have a clarity of thought where they have certain businesses which give them cash flows and where they have 100% ownership. Having said that, what is important to understand is when it comes to world of technology, ideas are no one has a monopoly on ideas. So idea generation can happen anywhere, and most of the idea generation generally happens in campuses or in small time cafes and stuff like that. They don't happen in large corporate boardrooms. And I think they very well recognize that, and as a result of which, when they come across some great ideas on the technology side and they find that those ideas along with good set of people, then they invest into those businesses as an investor. So it's a comprehensive play on the technology evolution or the technology curve that India is going to experience over the next 15, 20 years. From view that it has all the potentials and the makings of a very large company. In my view, probably it will become an index stock in India in the next 5-7 years.
Okay. So you guys, I just got you guys talking about technology. I don't know about technology. I'm not going to name the subscriber, but I've had massive issues with this one. But anyway, now that I'm back, lest it sounds like a recommendation, a short or a sell here. But Sandip, your last pick, which is Inox. Why Inox, Sandip? I mean, when you have Lakshmi Bomb, Sadak 2, everything releasing on OTT platforms, who needs the movie theaters anyway?
Yeah, so I think that's what I said initially, that if we want to invest in this market and make money, you have to look for deep value companies which might not have visibility today, but have the balance sheet and the market strength to survive. So Inox, obviously, so it's virtually a duopoly in the multiplex business today with PVR and Inox. Both of them are going to have no revenue this quarter, maybe no revenue next quarter, maybe some revenue in the following quarter. But the point is that they have virtually no debt in the balance sheet, so it will help them sustain. So it helps them survive and move forward. The stock's around 60% off the top, and eventually, so it depends on what you believe is going to happen in 2021. If you believe that there is going to be eventually a vaccine, not as per what ICMR is saying, but eventually globally there is going to be a vaccine which will find its way into India also. And in 2021 we will get vaccinated, this disease gets controlled and things go back to normalcy. So I am the normalcy advocate. For those who are not the normalcy advocate, this is not for them. So I am the normalcy advocate. I believe that a year from now, things will be absolutely as they were in the past. Things don't change. Maybe some more people will start working from home. So this doesn't change things too much for me actually, but for many people it's changed. So I think those things will obviously happen, but I think people will spend on entertainment, low ticket item consumption. So I think these things will come back very rapidly. So I think that's why you have to look at deep value in companies which will come back and are in a market position. Whenever their businesses restart in a big way, they will regain their market share. So that's why I say Inox market cap, if you look at it today, is just around 2,000 odd crores. Last year they did a turnover of 2,000 crores. Can they go to 10,000 crores in the next 10 years? Yeah, maybe yes, they could go to 10,000 crores. So I think that's the context in which we have to look at these stocks now. What will when they are not operating, so I'm not sure what will happen to the stock price next month or next month or next 3-4 months. I'm not sure. Maybe people can get it cheaper. Maybe it will not be cheaper. So I think, but eventually it was trading at 500 odd in January. Can it go to 500 again in 2 years? I would think so. If it goes to 500 in 2 years or even 3 years, it's 150% up from here, which is no mean return in a economy where FDs today yield 4-5%.
Okay, but my only question, Sandip, here is it going to be that gold kind of investment? Do you need to have a large concentrated bet to Inox purely because it's a contra buy? Or would you say contra buy right now, that is? Or would you say take a small exposure, see where things goes? Because even from the March lows, it's still down 90%. I mean, so what that it's recovered 40% from, its 52-week low?
Yeah, so that's what I'm saying, that next 2, 3, 4 months, I'm not sure where it's going. So maybe people will have an opportunity to accumulate it at current levels, somewhat lower or somewhat higher. But But I think that's not the bet that needs to be taken. I think the bet that needs to be taken is that in 2 years' time, will the world and India be normal? Normal in the sense that economies might still be under stress because of fiscal strains and whatever debt has got built up. But will people start living the same way they were? So I do believe that it will happen. If that will happen, then some of these companies will do very well. And so I think which will include many of the travel related. So unfortunately, we don't have too many players in India to play that. But that will come back, and as that comes back, these stocks will recover. So I think that's the play.
Okay. Seeing my telecom troubles, we have a lot of panelists or rather attendees asking about what's the view on Bharti as well as Idea. Manish, come in here because two very different stories. You've got the month-end overhang of the ruling on the AGR dues as well. But firstly on Bharti, promoter dilution coming in. We know the stock is in good stead. The telecoms story is here to stay. But is this the price to buy Bharti afresh? Or would you wait for lower levels than 560, 570 thereabouts where it's currently trading at?
So the story of telecom has undergone a massive change in this pandemic. I mean, we are now used to, working from home and, telecom and mobiles and Wi-Fi are the backbone of today's business. And this is going to change.
And we're paying so much for it now. It's no more free.
Yeah. It's no more free. Yeah. And so, this is going to stay. It's not going to get reversed once the pandemic opens up. The lockdown gets lifted. It's not going to be that. So it's a long-term play, and obviously you know that the ARPUs are going to move up because of the usage, the data consumption that's happening. The key point is at what point in time, when the ARPUs go beyond 200 rupees, and as they approach 250 rupees, in how many years can that happen? That's the big bet, whether you want to buy Bharti at the current price or lower prices, but that's eventuality that's going to happen. But just on this, I would always believe that Bharti will trade at a slightly lower multiples than Jio, because at the end of the day, a telco is a dumb pipe, and if you don't have a platform business on top of that telco, you're likely to not have a much more value addition than just being telephony or data consumption. But Jio on its other part is, along with the telecom business, they are actually leveraging a whole lot of software capabilities and e-commerce capabilities, and trying to bring out a total TMT platform on the network. Here is where you have the Facebooks of the world getting interested, because you have a chance to become the next Amazon or Apple or Google in terms of cloud and all those stuff. Can you marry all of that into this? So I would always prefer a Reliance over Bharti, because at the end of the day, Bharti still remains and is quite satisfied in just being a utility provider, and that's the telecom play, and it will trade at a lower multiple. But it's a given that ARPUs are going to move up. One needs to bet on whether it's going to happen in the next 2 years or 3 years, and based on that, either the price justification will be warranted.
Fair point. Okay, I think we've extended our time. I know there were a lot of other viewer questions as well, which I would have loved to take, but maybe next time, and hopefully my connection, I'm not naming which subscriber, is not going to snap in the middle of the webinar, but apologies on that one. Gentlemen, thank you so much for joining in today, and great speaking with you guys as always.
Thank you.
Thank you.
Thank you to all our attendees as well. Thank you so much.